And so talking about those analogs, maybe we can analogize this in the context of the history of ETFs and the similarity of concerns raised for things like leveraged ETFs and gold ETFs in the past.
Yeah. It's a great point. Crypto operates in dog years, right? A week in crypto is like a year in the traditional capital market. So crypto people are very anxious, and they look at something like Bitcoin, where the first filing was in 2013 and we're still waiting. And they're like, this is insane. But it is important to remember, whether it's non-transparent active or leveraged ETFs or gold, or even something as simple as bonds, those took multiple years, and the SEC raised legitimate concerns. This is nothing new. You're absolutely right that the concerns are different in each case, right? On non-transparent active ETFs, the primary concern was on arbitrage. On levered ETFs, a lot of it was on risk disclosure. Gold may be the most analogous in that there were significant concerns about custody, pricing, and the existence of regulated derivatives markets and other factors. And the SEC ultimately got comfortable with it. Look, if you ask me, was the Bitcoin market ready for an ETF in 2013? I would say no. Was it ready in 2017? I would say no as well. Now, do I think it's ready now? I think it's ready now, but that's up to us to convince the SEC. So that the market has matured, we're getting closer. And I think, can't guarantee, but I think we'll get there eventually.
And so as we think in terms of ETFs and structuring ETFs for the Bitcoin or any digital assets for that matter, you and I talked a bit about strategy considerations, whether it's a digital asset fund like Grayscale or other ETF structures. How do you think those strategies play out with regards to an ETF? By that, I mean things like lending, staking, forks, leverage, AMM. I know I hit you with a laundry list. You can go through it as you like. Yeah. But it's obviously going to be a component of any ETF, and would love to get your thoughts on that.
Yeah, my view is pretty simple, is that what people want when they're looking to invest in a hypothetical Bitcoin ETF is just exposure to the beta of Bitcoin. I could be wrong, but in my view, they don't want you to lend out your Bitcoin and earn an extra 5%, but put the entire capital at risk from an event you haven't anticipated. They want you to be able to claim forks should they occur, but only if they're meaningful, because you can sometimes put capital at risk if you do that, and only if you have diligenced processes in place for when and how to claim and liquidate those forks. People just want exposure. One of the unique things about working at Bitwise is we've had funds in the market on the private side since 2017. So we've managed through things like the Bitcoin Cash forks, and those are complex situations. But I think the model for people to think about is plain vanilla, like as close as we can get to GLD holding bars of gold buried under London is what people want in a Bitcoin ETF, I think. They don't want futures exposure. They don't want you earning an extra 10% yield by lending it out. They don't want any funny business. They want something as close to WYSIWYG and as secure as they can, because quite honestly, historically, the beta of the Bitcoin market has been pretty good, right? The best performing asset class in the world, 8 of the last 10 years, up nearly 300% last year. In that market, what matters is you minimize risks and you get simple exposure. And I think that's where we'll get, I would expect, whether it's Bitwise or another provider that ultimately gets approval, if we do, for a Bitcoin ETF.
And it's a good point also in terms of complexity. Certainly, when you're looking at trying to get something even approved for the first time, you're going to give them a dish of vanilla. You're not going to say, hey, we're 5 different flavors, 4 different sprinkles, in a hard-shelled chocolate coating on top. That'd be just like, no, I don't think so. It's easy. But in the context of different digital asset funds, and the continuum from an ETF plain vanilla to the different strategy considerations in a digital asset fund, I know you have thoughts on that. And even when we talk about digital asset funds, we think about Grayscale. And certainly now there's, even this week, a 9-point came out. I'm sure you're familiar with that. They're going to apparently lower management fee and eliminating a lockup period. So they're going right after Grayscale, but I digress a little bit right now. We'll come back to that. But thinking in terms of the funds and now even potentially the coins themselves, like in the DeFi space, being their own strategic considerations, and the ETF, maybe talk about how you view some of these strategic considerations and how they fall into each bucket, from the simple to the more complex.
Yeah. It's a great question. First of all, there's a product design perspective. And if you think about from a product design perspective, what everyone wants is the ETF, which is WYSIWYG and available in traditional custodians and trades on a traditional exchange at bid-ask spreads that you can see. That's what everyone wants. Everything we have is some imperfect version of that. It could be a private fund that's only available to accredited investors and has paperwork burden. It could be an OTC traded shares of a private fund that can trade at substantial premiums and discounts. It could be a venture capital fund that has a carry on top of it. It could be buying it on your phone and exposing yourself to SIM risks, or the Apple iOS risk that was disclosed yesterday. They all have hair on them. So we're chasing this platonic ideal of exposure as close as we can to get to it. And right now, investors have to wrestle with which pluses and minuses of the existing approximations they want. When you get beyond the product structure question and you get into sort of strategic design in terms of coins and other things, you really have to think about, I would say, three things. And you have to evaluate providers on these three things. So the first thing I would encourage people to evaluate providers on is to get back to that sort of binary or uncompensated risk question. Is the security design of the fund adequate to meet your needs? Do they have processes in place to evaluate coins from a regulatory perspective to screen out regulatory risks? Are they considering the liquidity of the coins, et cetera? Because this is a market that emerged from the grassroots to where it is today. And it's not like the traditional equity market. So even in something, we run a very simple strategy, right? We run a crypto index fund. That's like the S&P 500. But I can tell you the amount of diligence we have to do in this space compared to a traditional equity fund is significantly higher at the index level. I edited the Journal of Indexes for 10 years. I'm an index geek through and through. And this is a complex ecosystem, even to do an index strategy. But beyond those binary risks, then you have to talk about sector exposures. You and I know, and many investors don't know, that different crypto assets are going after completely different markets. And maybe not completely different, but very different markets. And so you have to decide which of those markets you think are most interesting. And then once you decide that, and that could be broad-based, it could be Bitcoin only in the digital store of gold, it could be DeFi, it could be Web 3.0, there are multiple spaces. Then you have to decide active versus passive. Crypto likes to talk about everything being new. It's really the same thing. It's just different things are more emphasized. Product structuring, more complex, security and other risks. But then you get down to active and passive and sector exposure, and it's actually very similar. And there are lots of sectors that I find very exciting in the space.